Good evening, ladies and gentlemen, and welcome to another episode of the Stock Market Brief Show. We have some interesting charts to share with you today. Things are getting very, very tight to a point where we may see some very explosive moves in names that we haven't seen much action whatsoever. So that's what we're going to talk about on today's Stock Market Brief Show. We're going to go over the opportunities, the risks, and all that and more while we navigate the financial markets through the lens of technical and intramarket analysis. Let's go ahead and get into today's episode. All right, everybody, welcome back to the episode. First, I want to start off looking at the CME Fed Watch tool. It gives us the probabilities of a potential rate cut. And as you can see, we are pricing in that cut here in September. We do have Jerome Powell coming out for a testimony tomorrow. We have Yellen tomorrow, and we have also on Wednesday Powell as well. Going into Thursday, we get core inflation data. Friday, we get PPI. So one can say this could be quite the week of data and surprises. Maybe perhaps when we get some more of this information to get closer to that July meeting, we'll give more insight whether or not we'll see that rate cut in July. Now, it's going to be important to see what happens from this probability standpoint, because in the past, what we've noticed when we start going from a rate hike cycle to a pause and going to cutting, we actually see volatility in the markets, which we've seen multiple times. I'm actually sharing with you an IWM weekly chart. Here's the federal funds rate. Here, down here is the 10-year minus 3-month yield. Yes. And you can see it's red right now because it was inverted. It's inverted right over there and right over here. And as we start to cut rates, we begin to uninvert. And there shortly after, we get all of a sudden some sort of volatility event and we get some sort of spike in volatility. And you can also see that the best time to really buy small caps is, well, when money is cheap, meaning the federal funds rate is smashed down there to the ground. You can see what happened. Well, when we smashed to the ground, we went up on a big rally. It wasn't till here where we started to get more chop. Why did we see so much chop here? Oh, what do you know? We started raising rates there again. Well, we came back down. We cut rates after this big old pandemic little hit there, and then the market took off to the upside. It wasn't till we started lifting rates again till what? We started to see some chop and volatility. So one could expect that if we do start cutting rates and we start to uninvert, perhaps that might actually hurt small caps to the point where we see another volatility event. However, there are opportunities still here for potential upside. And that's what I want to talk about. And that's what was on this specific thumbnail. Now, if I look at this specific thumbnail, it's showing you the times that the Bollinger Bands on the IWM got very tight. Right here is the Bollinger Band width. It's measuring from the high part of the band to the low part of the band. It's not displayed on this chart, okay? But it's basically showing when it goes down, the bands get tight. When it goes up, the bands expand, meaning price action, it gets tight and then goes crazier and starts to expand. And in times of expansion or during times of contraction, if you understand the basic principles of technical analysis, one of them is assets or stocks, equities, markets. They move between periods of contraction and expansion. So if I pull this up and I say, wow, we are very tight here on the Bollinger Bands. When's the last time we've been this tight? When's price action coiled up this much? Well, we go back a little bit. Oh, not this year, not that year. Oh, not this year, not that year. It wasn't till 2020, early in 2020, that the bands got very, very tight, and then we saw a sudden expansion. Which might be like saying, Mike, but it could be also expand to the upside, and that's absolutely true. This could be a one-off because it was the pandemic. But let's go back a little bit further, and it was into September, October of 2018, where we actually shortly expanded to the downside, known as the crisis, or the Christmas Eve massacre into the end of December. So are we going to see a very similar situation? I don't know, but we'll get a little bit more into detail of what we can expect by looking at other different charts. You can see back over here in October, November-ish area of 2017, we saw a nice little move to the downside, but we saw then a quick rip to the upside, and then volatility came to the downside, and then to the upside, back to the downside, right? So a lot of volatility took place there in a short order. So as the Bollinger Bands are getting tight, we can assume that it's very likely that we can see some explosive moves, whether that's to the upside or downside. I'm not too sure. And if you want proof of, us calling this kind of stuff out in the the past, just take a look at this tweet. This was from October 14th, 2023. This is when the NASDAQ composite was roughly at about 13,000. We were kind of flagging out here. And what we pointed out on the weekly time frame was, wow, we haven't seen the bands from a weekly perspective contract this much since, well, October of 2021. And there shortly thereafter, we expanded to the downside. On the flip side of that, in October of 2019, we saw an explosive move to the upside as volatility expanded. And then in the Christmas Eve massacre, you can see also here going into 2019, the bands were getting very tight and we saw that explosive move to the downside there. If you want an updated chart, well, this was when we called that out, and you can see we've seen an explosive move to roughly about 18,500 in the NASDAQ composite. So does this mean that, hey, is this going to be bearish like these last times? Is this going to be bullish? It's too hard to determine, but one thing is certain. If price action gets tight, and say if you're bullish and it goes in your favor, you can see an expansion of volatility at your back, which could be a very beneficial thing. If it goes against your position, you can get out for minimal risk. And we'll show the IWM chart momentarily. There are still a couple bullish things going on in like broad market. So let's take a look at the bullish percent index, for example. We know that bad breath has been in the market, right? The S&P 500, the Qs, they've been going up, but yet a lot of stocks have been going down. Well, take a look here. We're actually getting a reading that we haven't seen. I mean, it's the lowest that we've seen in all of 2024. Okay, the lowest reading we've seen as the market's kind of pressing higher and just going sideways. This is the New York Stock Exchange Bullish Percent Index. And you can see over here we have a low, a lower low, a low, and a higher low there in the RSI. And these divergences, they do matter, right? Especially during extreme periods of time. So I'm calling this out because are we going to start to see broadening breadth? Meaning, are we going to see some of these equal weight, positions start to move in our favor? Some of these smaller caps, mid-cap names start to move in our favor. And it's a possibility. You see this low right here and this low right here. We'll take a look at this low and this higher low right there. That bullish divergence played to the October, November 2023 bottom and played it to the upside quite well. If I do show my shelf. Next thing is the NYSE Summation Index. Today we just got a bullish crossover on the parabolic SAR. So what does this mean? It means that we can identify a potential change in trend. Potential change in trend. Once again, a potential change in trend. These could also be whipsaws, but in the last couple of signals where we had one here, one here, one here, you can see it's been pretty good at spotting the turn. So we spotted the turn, boom, it started moving sideways, going up, and spotted the turn right here, boom, it spotted the turn right here where it's been going sideways. So right now it's starting to curl up. The McClellan oscillator is above zero, so that could be positive, and it could be the early signs of a potential move to the upside, which lies well with this positive divergence plane with a bullish percent index. While that's taking place, I thought this was an interesting chart too. I'm looking at growth relative to value. The reason why I'm looking at this is because, well, there's been a huge move in this relative strength line, okay? The RS line of growth versus value. So what does this mean when it goes up like this? It means growth has been outperforming value names, right? And what I'm seeing here is somewhat of a divergence taking place in the RSI. We actually last time talked about it when we got very extended on this high move of the rate of change. And we said this is where you can typically get some pullbacks in like the Qs and stuff like that. We did get that. And then we saw it blast back up, creating another negative divergence, both in the rate of change and the RSI. So if this starts coming off, that means we can potentially start to see that rotation take place in the very near future. So let's take a look at IWM right now. So IWM has been going absolutely nowhere, right? It's been basically in a very choppy range that is getting tighter as we speak. Today it was up about 0.7%. It was up further. It was up around 204. And you could see it's holding on to this, lower high, but it's also holding on to these higher lows trends. So as price action is getting tighter, the Bollinger Bands are contracting to levels that we haven't seen in quite some time. I would say be on lookout if we start to break out through that 204 to play it up to around 210 and potentially maybe even higher. You got to manage risk. But if it goes like this and breaks down, also be very mindful because you can have an expansion of volatility, right? Where price gets clipped to the downside. Speaking of volatility, I did find this very interesting today. The VIX. Okay, there were some big orders, so I just pulled up my charts of the VIX, and I was like, oh yeah, this is cool. I remember that the VIX Bollinger Bands got very tight here in 2024 to a level that we haven't seen since 2007, right? That means volatility has been coming off. Bands have been getting very tight. It's pretty interesting stuff. And then I saw today, when I was looking at this, I was like, whoa, shoot, look at this structure right here. And this structure right here is very, very similar. In fact, if I pull up 2007 structure and 2024 right now, you saw the bands got very, very tight that we haven't seen since, 2000. So this was where it got very, very tight. And what happened after that red line? We saw a spike very suddenly, and then it started to come off. We saw a spike very suddenly, and it started to come off. So it's acting actually very similar. Not to say that we're going to have the same outcome. However, we know what happened shortly thereafter. It's not what you think. We actually saw it go sideways, and then we saw a spike up to around 30. Okay? That's where the volatility really started to expand, and even the Bollinger Bands. It wasn't until later, right, into 2008, where we saw the big move in volatility up to the 77. And now I'm calling this out because if you look at the VIX today, there was some pretty large orders that hit the tape. You can see over here, $45 calls. So this is a spread. So we got a pretty large size hedge going on with upside to potentially around 45. So as we're talking about this, the 45 would be way up here. Very similar structures to what we saw over here. And then we saw this big pop. So are they prepping for a potential move like this? Is there, a potential event going to be taking place? Or is this just obviously protection against some larger portfolios? I don't know, but it is something to be aware of taking place in the background. On the prior video, we talked about the housing market and how it was diverging from the S&P 500. And we talked about the correlation from a weekly perspective, that it's never been really good when we get these deep correlations. Well, I just wanted to show the updated chart. We literally are at almost a 0.9, well, we are at almost a 1-for-1, but it's minus 0.91 on the correlation scale, which is the most negative I've seen this correlation dating back as far as we can go back here on this specific chart into early 2000. What you'll see is when we get these deep negative correlations, we've seen volatility pick up there shortly thereafter. Are we going to be seeing the same thing? We'll follow up on the last time we talked about this, but you can see over here on just the daily time frame for the housing market up top, S&P 500. And we talked about these, negative divergences where the market press is higher than the S&P 500, but the housing market doesn't match, and it led to some sell-offs. Same with the bullish divergence, led to rips up to the upside. And then we have this negative divergence currently forming there in the housing market. Now, the last time that we talked about this, we talked about this specific chart. This is the S&P 500. And this is where you got to get very tactical, okay? Because people see the thumbnail, they see the title, they see the first part of the video, and they're like, see, why are you so bearish? Everything's so bearish. Well, if you actually watch the videos, it's all about being incredibly tactical. In this specific period, which you can go to the end of the video, on the last video, and see, we said anything above 5,500 is bullish, target 5,550, and then 5,600. Why 5,600? 5,600 is where all traders are reaching out to. Not all, but you get my point. That is the call wall based on gamma. And it wasn't until we said, you get below 5,460 or this 5,450 range, that's a cause for concern. Well, what happened? Let's take a look. Kaboom, we saw a massive move from 5,500, which is this level right here, right? We have some updated levels. So this is that 5,500 level. We got above it. We went to 5,550. What happened? We got above it. We got rejected. We came back up. We got rejected. And then we came through it. And now we're trading up north of that 5,600, which is much larger in size from the last time we talked about it. And from that point, I should also note that traders aren't really reaching past 5,600 in this current moment. So if we can get up there, this would be the upside target. And if traders do not continue to reach out further to 5,600, I would suggest we can see something very similar to as we saw right here at 5,500, which was we broke above it, we came back down, we came back up, we came back down, we came back up, we came back down. It's not until we get into negative gamma territory which you can see some real sell side activity. Think of it as like walking a plank, right? If you get below, if you're walking the plank right here, jumping off is the gamma flip line. And if you jump off, you're going to be, dealing with some volatile waters. It's not until you get out of the water, dry up, and then potentially see volatility contract, and you start going back into an environment where you start buying the dip, selling the rip, buying the dip, selling the rip, buying the dip, selling the rip. And we're pretty far off of that. The current flip line right now is 55.10. I would be expecting to see this thing go up if we're going to be floating around 5,600 in the very near future. Now, if I take a look at the SPY on the 15-minute time frame, there are going to be some important levels to pay attention to. Not only are we in positive gamma territory, we're above a rising 5-day moving average. Check, check. That goes to the bulls, okay? Is it frothy? Yeah, sure, but it's still in bullish context. Okay, today was one heck of a chop day. If you managed to be in the live stream, we basically traded one time from a low back up to the daily VWAP, week to date anchored VWAP, and then called it quits there shortly after because we just chopped around all day. Okay, waiting probably for the Fed announcement or the testimony for Yellen, for more macro data to come out. Which, with all that said, we have a weekly upper expected move at 561.23, a lower weekly expected move at 548.05. I would imagine that we're going to be tagging one of these in the very near future. My thought would be that we go higher given the current context, but don't be surprised if we consolidate and go sideways just a little longer, right? We went on a very strong move and now we're flagging out, consolidating. Our lower daily expected move going into tomorrow is 553. Our upper daily is 557. What are these levels? These levels are based off of implied volatility, right? Think of them as a distribution curve. 68% of the time is one standard deviation will close within this risk parameters. If you go 2 standard deviations, so it would be a little bit bigger of a move, that would be 95% of the time will close within those ranges. So when you think of things in terms of probabilities, you can create trades when you get outside of them, when you get near them, when you start to see strength or when you start to see weakness if you're shorting or so forth. Now, it's July 8th right now, okay? We're going into July 9th, and we're already about up at the monthly upper expected move for what the market price in for the month, at least I believe it was. Let me just double check while we're here. The upper monthly expected move for the SPY is 560. Yes, okay, that is correct. So this is also in line closely with the upper weekly expected move. So if we get up into these areas, this would also probably be very close in confluence with the level that we talked about up here at 5,600. So yeah, this would be a level I'd be very aware of taking profits, you know, in your portfolio, right? Like this is where if you've been catching this move to the upside, you want to maybe not necessarily short it because who knows how high it can go, but you could potentially look to take profits, update risk parameters, put on hedges, whatever the case may be when we get up into these ranges up here, because those are some strong moves. In the last couple of months, we broke through the month to date move, but we came right back in, right into it and then bounced from those levels, okay? Now, let's talk about some more opportunities in the market that I've been kind of seeing brew, and they're starting to get tight, and I think that you need to do a little research yourself as far as what names are in these, but I'm going to start off here. This is Vanguard's midcap growth ETF. Now, the reason why I'm showing growth is because growth is where the money's been flowing into growthy names. But I'm talking about the names that maybe haven't been getting love, like some of the larger growth names, the mega cap names. And this is the mid cap growth ETF by Vanguard. And if we are going to get breadth into the market, perhaps these type of ETFs, maybe individual names within it, can very well benefit. And you can see price actions getting very tight. You're kind of in this ascending triangle formation. So if we can break, boom, we can maybe come retest 235 and very well potentially break from this base that it's kind of been forming in recent time. Now, if it breaks down, what do? You get out. You watch out, because if volatility wants to expand to the downside, let it do so. And if it comes back and recoups, it'll set back up where you can get in for a better entry. Not necessarily better as far as price, but better as far as risk to reward is what I'm trying to say here. So that's the current structure of that. I'll also look at MDY, midcap. This is S&P. This is S&P Spider midcap ETF, 400 based on 400 names. So you can also go into like Google the holdings here and see what names might show a little bit more relative strength or so forth. Now this right here is getting very tight. Now I showed you the IWM earlier, right? The IWM is also getting tight, but it's a little bit more sloppy than something like this is. It's getting a little bit more tighter, offering up a little bit better risk. So if you start to see a breakout through these 535 little levels over here, right, before obviously breaking down, right? If you start to see the breakout take place, then you'd have a pretty tight risk to pretty good reward there, potentially even higher in the near future if that's going to be the case. Now, if we start breaking down before we break out, then obviously it's a cause for concern and you need to let price action do its thing, right? If you break down from here and it expands, perhaps we go reconnect with the 200-day. Perhaps we go test this prior low over here and it's just in a range trade, okay? We don't know yet, so it's best to kind of wait for some type of confirmation. And if you enter early, right, if you get into names early, right, be it MDY, be it whatever it is you feel comfortable trading, if it breaks down, just respect it. Respect it or have a plan of how you're going to trade through that time period. The last one I want to go into here as far as potential opportunity is still utilities. Utilities, these last 3 trading days have been getting incredibly tight, right? So we see this one range candle. Okay, I'm pointing at this one basically specifically there, but I'm going to just draw it. So we have one range candle, then we have another range candle, a little bit bigger, and then we have a smaller range candle. So price action is tightening up, which means that if it starts breaking down from the lows, we may come back into the gold fib zone. However, if we do start breaking to the upside, we may be, bouncing more from this 50% retracement that we saw from this low measured to this high as it's been consolidating nicely here. So if you don't want to trade XLU by itself, you can look at, individual names like, right, NEE is one of the top holdings there. Duke is another one. I forget what these charts look like. SO, right? I'm in one of them too. SRE, I think it is. I don't quote me on that one. I already forgot the ticker. But these are some of the names within XLU. Sometimes people just like trading leveraged funds. There's UTSL, right? UTSL is like a 3X. So be careful with those. Understand what you're buying if you buy a leveraged ETF and what that actually means. That's all I got for you on today's show, everybody. I hope it helps out. Gave you some cool insights into what the market is doing and some opportunities there too as well. See you later.